Hello and welcome to Making Sense of Markets, second quarter 2016. I'm Sheldon McFarland.
And I'm Matt Carvalho.
And we'll be your host today. Thank you for putting down the Pokemon Go app and tuning in. Let's start by addressing the elephant in the room, Brexit. What is it and should I be worried about my investments?
Well, Brexit was easily the biggest financial news of the quarter, and really it was just a simple referendum to citizens of the UK whether they would like to remain or leave the European Union. Going into the vote, many polls predicted that the Remain would carry the day by a slight margin, but in fact, as the actual votes were tallied, it was a bit of a surprise that the UK decided to leave the European Union.
And it wasn't long before all the bearish doomsayers started in with drastic pronouncements. Looking at some of the headlines that we captured here, after Brexit vote, investors are gripped by a panic last seen in 2008. Brexit to trigger worst bear market you've seen in your lifetime. I fear the Brexit could be the beginning of the destruction of not only the EU, but also of Western political civilization in its entirety. Even household pets got involved.
It is pretty bad when even dogs and cats have to weigh in on Twitter. And certainly stocks and currency markets reacted accordingly. We saw a pretty big drop following the Brexit news, with the S&P falling about 5% in just the next 2 trading days, and the UK and Europe falling even further. Yet as bad as that initial sell-off was, when we look at the performance of global stocks for the year, we can see that it wasn't the catastrophe that many predicted.
And we've seen that markets have continued to rally into Q3, showing that the initial recovery was more than a dead cat bounce. Moving on from Brexit, we don't have to look far from home to see our own political drama playing out, with an unusually contentious political season.
We've covered politics in depth a couple times on this broadcast and on our blog, advisorinsightsblog.com. And basically the takeaway that we always get to is that it really doesn't pay off when thinking about your investments to try and predict who's going to win the election, which party is going to be in office, or if you should enter or exit the market at that time. It really is a fool's errand to try and read too much into it.
Yeah, and you don't have to look very far back in history to realize that the recent political quips that we've seen between parties, it's not unprecedented.
It's easy to think these days it's uglier than ever, but boy, I tell you, I went back and looked. 1964, we saw this Daisy commercial that Lyndon B. Johnson had put on, basically saying that a vote for Barry Goldwater was going to lead to nuclear destruction that would wipe out the nation's children. Way before that, in 1828, John Quincy Adams said that a vote for Andrew Jackson would lead to murder, adultery, and pimping in the White House. And well before that, close to the founding of our nation in 1800, John Adams basically said, if you support Thomas Jefferson, you better be ready for murder, robbery, rape, adultery, and incest to be openly taught and practiced. It seems the more things change, the more they stay the same. So enough with all these ugly politics and foreign referendums. We know you're probably tuning in because you're concerned with your own financial plan. And frankly, that long-term plan shouldn't be influenced by these short-term political headlines.
You know, I thought last quarter I'd seen everything, or I thought I'd seen everything until last quarter in the way of financial advice. We actually saw financial advice from a comedian, and it turns out it was pretty good. If you keep up with late night television, then you may have seen the entertaining segment on retirement on HBO's Late Show Tonight. It's hosted by John Oliver.
This segment's been racking up the hits on YouTube, and it turns out, in addition to being pretty darn hilarious, the advice is really good. It's well worth your time if you haven't watched it yet.
Oliver highlights 5 keys to retirement. Save now. Use low-cost funds, hire a fiduciary advisor, shift from stocks to bonds as you age, and keep fees low. Now, if you're listening in, then you probably have this list covered, but we still wanted to take a look at it as professional money managers and advisors to see just how good it is.
So if we take a look at that first one about saving now, we really viewed it as the idea of saving early and often. And in a very simplistic example here, you can think of 2 different investors, one who starts very early on at age 21 and simply contributes $100 a month until the age 30 for 9 years of contributions totaling $10,800. Investor 2 starts a little bit later at age 30, but contributes for an entire 35 years, contributing nearly 4 times the amount, up to $42,000. But yet, by the time they both reach age 65, Investor 1 actually had a higher dollar amount in their account. Now we know this doesn't apply to everybody, right? There's probably not too many people tuning in with us today that are age 21 and can make this change in their savings plan right now. But I think even for investors who are nearing or already in retirement, the need for financial planning is great. For example, a 70-year-old today is actually expected to live, on average, at least another 16 years. That's a pretty long time horizon that you're going to need your investments to grow.
Oliver's next point we termed efficient investing. Are you investing efficiently?
And here, we're really thinking about the idea of active versus passive, or the amount that you're paying to get the exposures you're trying to in your accounts. And we wanted to reference the study that was discussed in the New York Times, in which they looked at 2,862 US-oriented mutual funds in 2010 that had been at the top of their peer group. And they tracked those over time and found that each year fewer and fewer of them were able to maintain the level of that high performance. And by 2015, none of them remained in the top quartile.
Now, given these findings, we encourage investors to steer clear of active managers. They have high fees, high turnovers, and they usually don't beat the market, so it's not worth it.
Now, we believe there are some key ways that you can improve on a simple indexing approach, but by and large, we advocate broad-based, efficient market exposure.
Oliver's third point had to do with the term fiduciary.
I know that's not a common word that most of us have usually used over time, but it's actually becoming a bit more popular these days following a recent Department of Labor ruling requiring financial advisors who advise on retirement funds to act as a fiduciary to their clients. Now, basically, a fiduciary is someone looking out for your best interests.
And odd as it sounds, prior to the recent ruling, not all financial advisors were required to do this. Many simply had to recommend investments that were suitable, but not necessarily in your best interest.
I was trying to think of an analogy around this regarding other professions and how this might look in different fields. And something that came to mind was the idea of going to your doctor, right? Let's say you had a heart condition that you need to have diagnosed. Well, you'd assume you'd go to your doctor, they'd evaluate your situation and prescribe the best solution available. However, what if your doctor didn't work for a healthcare group or the local hospital, but instead worked directly for a particular drug manufacturer? Would you still be sure that their prescription of a Pfizer drug would be the best solution, or simply the one that their company is selling? That's the concern with financial advisors. We believe the advice you receive should never be compromised, and you want to ensure that you're working for an independent, fee-based advisor who will act as a fiduciary to you.
Next, Oliver suggests you move money from stocks to bonds as you age. In general, that's a great rule of thumb to reduce the amount of risk in your portfolio as you age.
But unfortunately, it's not always that simple. After all, the range of returns on stocks is far greater than bonds. And as your human capital, basically the present value of your future income from work, declines, taking less risk with your financial capital is often a prudent one. However, your situation is unique, and a simple rule of thumb may not suffice. A financial advisor can tailor your portfolio to your specific situation. Let's say that most of your funds are going to go to an inheritance or a charity bequest. A higher stock allocation may make sense even in an advanced age. Or conversely, if there's a need for a lump sum, let's say you're buying a house soon or have some other major purchase coming up, then a more conservative allocation might actually be called for.
Oliver's last point dealt with fees, and as the comical domino segment showed, fees are important and they do add up over time.
And Oliver mentions cost, but we would argue that value is actually the more important metric.
A financial advisor simply delivering a lineup of funds may not provide a huge value to an investor, but an advisor helping with financial planning a more comprehensive level of can easily justify their fees. According to a Vanguard study, an advisor can actually add roughly 3% in value through things such as rebalancing, asset allocation, and behavioral coaching, which is keeping investors invested during those volatile markets.
And when I think of value, another idea that comes to mind is something like upgrading your phone. And you're often faced with a couple options. You could go with something that might be a little bit cheaper or maybe even free from your phone company. Or you might have other options available that might cost some more. And you'd say, well, why would you ever pay more for a phone when you could get one for free? Well, in some cases, there might be enough features or functions that the utility actually get from a phone is actually a higher value than taking what might be a cheaper option. And, thinking about the value that a financial advisor can bring, I was just speaking with a financial advisor that we work with earlier this week, and he was mentioning that he was pretty pleased when a couple of his clients actually called him up and said they had some additional funds ready to deposit to their accounts, that they were looking to basically capitalize on the falling markets following the Brexit. And, we all know that we can't time markets, that we don't know which way it was going to go from there, but those clients were acknowledging that the stocks they were buying were basically on sale compared to just the week before. And I think the difference in long-term returns between a well-coached client like those and others who panic at the first negative headline can really be enormous.
And that concludes the 5 keys on retirement by Oliver. Now, I'm no comedian, so I can't comment on the quality of the comedy in this segment, but as an investment professional, I can say that the advice he gives is generally pretty good. But he did leave off what we feel is one of the most important points, and that's the ability to stay invested through the ups and downs of markets over time. Now, we often picture, when it comes to investing, a smooth ride where markets just go up, but that's just not reality. And as we can see on this slide here, markets go up and down, and there are often down periods in markets.
That's what we looked for on this slide. We actually looked back to the start of this bull market in March of 2008 and are simply showing each period of time when the market fell by 5% or more. We find that there was actually 20 of those periods. And imagine what we've been through. All the worries about Ebola, credit downgrades, the flash crash, and that's not even to mention China, Greece, or quantitative easing, and all of those could have felt like the end of the world at the time.
Yeah, but despite that, the market, represented by the S&P 500 from March 2009 through the end of June of this year, returned 234%. You doubled your money and then some. But in order to earn that, you had to have stayed invested.
And so we'll start to wrap up here with a quick review of the Q2 returns that we saw in some different asset classes. So we see something like U.S. real estate investment trusts led the way during the second quarter with a return of 5.4%. Value and small cap companies also did very well in the U.S. And then to the right hand, we see international stocks did decline marginally for the quarter, with international large value losing the greatest amount at minus 2.2%. If we put that into a longer term context here, we have towards the right of this page the 2016 year-to-date numbers. And I think one surprise that we see there is something like emerging markets value being towards the top of the list, gaining 7.4%. And you could see in the previous years, really the last 5 years, it was towards the bottom of asset class returns that we're showing here. And it just helps go to show you that we're not able to predict which one of these is going to come up on top in any given quarter or any given year, much like that would apply to individual companies. Think about what we've seen in the third quarter here so far. Nintendo, the owners of the Pokemon Go app, their stocks went up by over 50% in just the first week after that app was launched. But you would say, well, if somebody was able to predict that, then there would have been analysts out there publishing reports saying, we need to buy Nintendo because this app is coming out and it's going to take the world by storm. But yet it was really a surprise. And that can often happen in investing.
So following the 5 steps towards retirement that Oliver laid out is a great start in the right direction. But if the last few weeks in the markets had you nervous and thinking about changing your future plans, then you probably need a better plan. At the end of the day, working with a financial advisor can help ensure that you have the plan that's right for you.